Hey, everybody, welcome back. Awesome, let's do it. So today, I want to share with you 4 reasons that give me the confidence that our growth trajectory is durable. I'll share more on our large addressable market and a relatively low penetration rate that gives us meaningful runway ahead. The power and the competitive differentiation of our AI-driven expert platform and how that helps us unlock this addressable market. Our strong growth franchise with exceptional assets at its core and multiple growth vectors ahead. And finally, our disciplined approach to running this business, delivering profitable revenue growth, and in the process, strong shareholder returns. It's important for me to start out by reminding you of our financial principles. These principles have guided us for years, and they remain durable. As a leadership team, we are focused on delivering organic double-digit revenue growth. I see ample opportunity for us to continue to deliver on this goal. And as a management team, this goal is our top priority. We also aim to grow operating income dollars faster than revenue. We want to make sure as we scale this business, we are also expanding our margins. We hold a high bar for how we use our cash. And the cash that we cannot invest at ROI in excess of our weighted average cost of capital, we return to you in the form of dividends and share buybacks. And finally, we run this company with an ironclad investment-grade balance sheet. As a business, we operate in large end markets where our integrated business and consumer platforms and our range of offerings address multiple customer needs. This market is in excess of $300 billion, and our current penetration is around 5%. The innovations you all experience today and the strategies you heard today are the keys to unlocking this opportunity. And a key part of unlocking the opportunity is the power of our AI-driven expert platform. The scale of the platform with nearly 100 million customers, the breadth of our offerings, the depth of our data, all with an AI-powered virtual expert at its core, is a meaningful competitive differentiator. It allows us to address current customer needs as well as anticipate their future needs. This is durable advantage. This is what gives us the confidence to continue to drive monetization and revenue growth. And the platform approach to running the business has played out quite nicely. In the last 5 years, our platform revenues have scaled at a 26% compounded annual growth rate. They represent 77% of the company's revenues today. And our business is largely predictable, with a meaningful part of the revenues coming on a recurring subscription basis. And it's that platform approach that yielded strong results last year. On the left-hand side are the objectives I shared with you all last year when I was on this stage. On the right-hand side is how we did. I'm so proud of the team's hard work of continuing our strong streak of doing what we said we were going to get done. Revenue growth, strong, organic, double-digit revenue growth. 13% total company, 14% platform. Grew operating income 16%, a full 3 points faster than revenue, in the process yielding strong margin expansion. And we were disciplined with our capital allocation, returning $3 billion to shareholders, $1 billion through dividends, which were up 16%, and $2 billion through buybacks. And in addition to delivering on our overall company objectives, we made meaningful progress in each of the focus areas we shared with you last year, starting with the Global Business Solutions Group. We shared that we were focused on growing with higher ARPC, higher complexity customers. That culminated in US QBO subscribers growing 11%, QBO Advanced customers growing 28%. We also shared we were going to accelerate our services revenue growth. That yielded services revenue growing 21%, a full 2 points faster than overall segment growth. We made meaningful progress executing on a vision of being the end-to-end platform where small and mid-sized businesses come to run their business. In the consumer group, we delivered 7% revenue growth with strength in TurboTax Live, the catalyst for future growth. TurboTax Live revenues grew 17%. TurboTax Live customers grew 11%. And we are confident that in the coming years, TurboTax Live will be the majority of the consumer group revenue. And rounding out our consumer platform, Credit Karma. Last year, we shared with you we were focused on re-accelerating this business, and we did, quarter after quarter after quarter. Credit Karma started with a 5% decline in Q1. It exited with 14% growth in Q4. We made meaningful progress delivering that combined consumer platform. In fact, Credit Karma customers falling with TurboTax was up 75%. We also made progress penetrating the under-penetrated prime segment. When you step back and reflect on the progress in the focus areas we had declared last year, we have unquestionably demonstrated that we have the right strategies, we have built the right set of capabilities, and we have set the table to execute and meaningfully scale these focus areas going forward. That gives us confidence in our ability to continue to deliver double-digit organic revenue growth. And when you think about our focus areas, what really stands out is our ability to drive monetization. As we have executed on our priorities, we have delivered the majority of our revenue growth through increases in volume and improvements in mix, including customers adopting more parts of our platform, while we have continued to price our products for the value that they deliver. I expect this trend to be durable. There are multiple vectors across each one of our business units that give me the confidence that we will continue to scale ARPC, starting with our Global Business Solutions Group. We expect ARPC to continue to grow as we drive product innovation, as we drive improvements and increase adoption of services across the platform, and as we disrupt the mid-market with higher complexity customers, such as those using QB Advanced, where ARPC is 5x higher. And our launch of IES even further moves us up on the ARPC curve. In Consumer Group, ARPC is going to continue to grow as TurboTax Live becomes an ever-increasing part of the business. ARPC in Credit Karma continues to grow as we drive adoption of our platform, as we drive increased spend of our platform by partners adopting more of our innovations such as Lightbox, and as we continue to penetrate the prime segment. And as we drive this monetization, we're also excited about the potential Intuit Assist and Gen AI provide for further acceleration. As a reminder, we see three primary avenues for how Intuit Assist drives business upside. First, by increasing customer growth and adoption of services, as we make it increasingly easier for customers to adopt the platform and discover capabilities across it. Second, Intuit Assist will provide a seamless unlock to an AI-powered virtual expert. So customers on a platform can engage with someone with contextual awareness of their situation, with deep expertise in their situation, in the subject matter they need to make a decision in, so that customers has the utmost confidence in the decision they're making. And finally, we will continue to learn and test about potentially launching Gen AI-specific SKUs, while in parallel, we always have a tenet of pricing our products for the value that they deliver. We made solid progress in fiscal 24 in Intuit Assist. It was offered to 30 million Credit Karma members, 24 million TurboTax filers, and 1 million small and mid-sized businesses. And the early results are quite encouraging. On the topic of conversion, we saw 9-point improvement in QBO trialers completing the onboarding flow. That has a direct correlation to conversion and retention on the platform. We saw 2-point lift improvement in conversion on customers in TurboTax engaging with AI-powered Tax Hub. 3% lift in conversion on Credit Karma by delivering Gen AI-generated, "Why is this the right offer for me?" On the topic of services, again, very encouraging results. We saw 10% lift in conversion when we used AI to deliver just the right offer to the customer through in-product discovery campaigns. And AI is also driving meaningful time savings, over 90% in MailChimp when they use our pre-built journeys, and helping customers get paid up to 45% faster by using AI-powered invoices. Some of those you saw in the product demonstrations today. We're early in this journey, as is the entire industry. But these results give us confidence in the opportunity we have to accelerate our business growth through Intuit Assist. And as we accelerate that business growth and drive durable revenue, we are also focused on driving margin expansion. I shared earlier, one of our principles is grow operating income dollars faster than revenue. That means each one of the expense line items on this P&L will be flat to down over time. We also expect to achieve our goal of having stock-based compensation get to 10.5% of revenue in the near term. Our approach to investing in our business has not changed. As a management team, we invest in the highest yielding opportunities where we see the potential to drive durable revenue growth. With the progress and the results we're seeing in our big bets, we are accelerating investments there. Starting with big bet one, we're accelerating investments to meaningfully scale Intuit Assist in the coming year. Big bet two, we are scaling investments in the product to embed virtual expertise throughout our offerings, and scaling investments in go-to-market to disrupt the assisted tax category. Big bet three, maintaining investments to continue to make progress on a better together consumer platform. Big bet four, accelerating investments to deliver best-in-class seamless money offerings and accelerating investments in international to increase our footprint with MailChimp serving as a tip of the spear for international expansion. And finally, big bet five, accelerating investments in the platform and the go-to-market capability, given the significant opportunity we see to disrupt the mid-market, both by addressing the needs of the customers who are already on a platform, as well as getting additional customers onto our platform. And while we accelerate investments in our big bets, we will remain deliberate on how we invest in our core innovation and run the business type expenses. You heard me talk about the importance of getting operating leverage. A key part of how we get operating leverage is our approach to running technology, customer success, and go-to-market as a platform across the company. This allows us to build something once and use it across the entire company, or take a learning in one part of the business and apply it to the entire company. And we are also using AI within our own business, in our own operations, that's having an impact on how we work, how we staff, and the efficiencies that we drive. As an example, in technology, we have two goals: accelerate the pace of innovation, accelerate the time to market to the innovation. By operating as a platform across the company, leaning into data and AI, we increased developer velocity 8x in the last 4 years. By using AI tools, we are improving our developer productivity anywhere from 10 to 30%. In customer success, we are building a consistent virtual expert platform across the company, and we're leaning heavy into AI. And the reason is, we're seeing that when we lead with AI-powered digital experiences, our contact rates are down. Already, they're down 11% this last year. When customers engage with Intuit Assist, 80% of them are able to get their situation resolved within 5 minutes without ever speaking to a human. That's efficiency at scale. That's operating leverage. In a go-to-market function, we're applying MarTech consistently across the company and applying AI consistently across the company to meaningfully improve the efficiency of a funnel, all the way from traffic to customer acquisition, down to long-term retention and adoption of capabilities across the platform. It is this approach of running these key functions as a platform across the business, across the company, that gives us the confidence in our ability to continue to expand margin as we continue to scale this business at a healthy, organic, double-digit revenue growth. And as we drive that operating income growth, we are staying disciplined in how we use our cash flow. This past year, we returned 65% of our cash flow to shareholders, both through dividends that were up 16% and through share buybacks. Share buybacks remain a key component of our toolkit to return capital to shareholders. And the approach to doing share buybacks has not changed. We limit buybacks to the cash that we cannot invest at ROIs in excess of our weighted average cost of capital. And at a minimum, we want buybacks to offset dilution from stock-based compensation over a 3-year period. This past year, fiscal 24, we were able to successfully use buybacks to offset dilution from stock-based compensation. Our goal is to be in the market each quarter, depending on market and other conditions. Now let's talk a bit about fiscal 25. I'm pleased to be guiding this company to yet another strong year. 12 to 13% total revenue growth, including growth of 16 to 17% in the Global Business Solutions Group, our largest business segment, representing 60% of the company's revenue. And another year of solid, strong margin expansion and 16% dividend increase. All this guidance is consistent with that which we shared at the August earnings call. With the context of what I shared, the large addressable market, low penetration, the strength and the competitive differentiation of the virtual expert platform, the progress we made on the focus areas, we have the utmost confidence in delivering our long-term expectations. 15% to 20% growth in the Global Business Solutions Group, with 5 to 10% growth in customers and 10 to 20% growth in ARPC as we drive platform adoption and disrupt the mid-market. 6 to 10% growth in the Consumer Group as we disrupt the assisted tax category and have TurboTax Live revenues grow 15 to 20%. And 10 to 15% growth in Credit Karma as we continue to scale our core verticals, grow in new verticals, disrupt the prime segment, and deliver a better together experience across the consumer platform. And objectives for this current fiscal year remain consistent. Deliver strong revenue growth, deliver strong margin expansion, stay disciplined in how you use the cash flow. With that, I'll close out where I started. The 4 reasons that give me confidence and should give you the confidence in Intuit's strong growth trajectory going forward. The large addressable market, relatively low penetration, and the range of offerings that address multiple customer needs. The strength of the AI-driven expert platform that is a meaningful competitive differentiator. The strong, durable growth franchises with exceptional assets at their core, with multiple growth vectors ahead. And finally, a disciplined approach to running the business, delivering profitable revenue growth, and in the process, driving strong shareholder returns. Thank you.